Welcome to GRE. I'm your host, Keith Weinhold. To most people, debt and inflation are about as welcoming as a restaurant 15 minutes before closing time. But with inflation at a 40-year high, learn more about how debt and inflation actually benefit you. Then an in-house GRE chat as we discuss the snowballing effect of real estate scaling today on Get Rich Education. The people that our listeners can't stop talking about are Ridge Lending Group, NMLS 42056. They've provided GRE listeners with more loans than anyone, and it's where I got my last few loans. They finance single-family income property up to fourplexes. They're the number one lender for beginners and veterans. Start your pre-qualification, chat with President Shaley Ridge personally, and get your custom plan for expanding your cash-flowing portfolio. Start at ridgelendinggroup.com. Checkbook IRAs have been ruled illegal by the U.S. tax court. With contribution limits 10 times what traditional and Roth IRAs allow, get total control of all of your IRA funds without paying the nasty UBIT tax with the Retirement Plan Answer Left Standing, the EQRP. You can invest your retirement funds in real estate, gold, Bitcoin, and even your own business. This works whether you're a solopreneur or have up to 50 employees. Learn more about getting started. Text EQRP in all caps to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Anchorage, Alaska to Anchorhead, Tatooine, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. Yes, to most people, debt and inflation are about as welcoming as a restaurant 15 minutes before closing time. Yes, the latest CPI inflation number this month came in at a hotter than expected 7.5%. So now the purchasing power of the greenback that's in your pocket, that's being diminished more rapidly than at any time since 1982. And really the big problem is that wages are not keeping up proportionally with that inflation increase. Many think they're trapped and they can't do anything. A lot of people just think that they're helpless about this 7.5% inflation. And depending on what measure you look at, wages are not keeping up with that. They're up somewhere between 2.5% and 5% in the past year. So, a lot of people, they think something, like, my car gasoline price is up and my boss is hardly bumping my wages, so I guess I'm just going to have to lose out. Yeah, really, that is what most people think. Because what else is up in price? It's real estate and energy and food and really most anything related to automobiles. In fact, an Amazon Prime subscription, their price just got bumped up for the first time since 2018 from $119 up to $139. That's a 17% increase right there. And there are myriad inflation examples. You probably don't have to look very far yourself in order to find them. Now, some people, even some smart people, they are still clued into the fact that the old system doesn't work. And they're thinking like, now, why can't you just work at a job for 30 or 40 years and then save a lot of money and then live off the money that you save for the rest of your life? Well, that doesn't work because the dollar's store of value is broken. Instead, you need to get into assets, and I contend that the very best one is cash-flowing real estate. Now, I'll give you more on how to profit from inflation in a moment, but now get this. That 7.5% consumer price index that was reported this month, that is a measure of how much more consumers are paying for goods and services compared to a year ago. But shortly after that, the PPI was reported. That's the producer price index. That's how much it costs producers to make stuff. So, of course, things get made by producers before those things are bought by consumers. So that means a high PPI, that can be a harbinger of future consumer inflation. Well, the PPI checked in also higher than expected at 9.7%. Yes, 9.7. So what happens then is that either this producer takes a hit to their margin, or else that price gets passed along to consumers. And by the way, there is nothing that indicates that this inflation has peaked either, so it could get worse. Now, as you look across your life, sometimes out there are some of these things that appear to make your life better, but they really don't. I'm thinking about you, autocorrect. Now, oppositely, there are some things that appear to make your life worse, but don't. And something like that is good debt. See, when you consider that you've got, say, $1 million in real estate debt on a fixed interest rate loan tied to a cash flowing asset, now you got to think about how debt and inflation are benefiting you. Not only do you have your asset values, which have probably rocketed up 15 to 20% in the past year nationally in real estate, which outpaces that 7.5% inflation, but with your tenants also making your mortgage principal and interest payment for you, your $1 million in debt, that shrinks to only $925K of debt after 1 year, and just $850K of debt after the second year, and on and on. And that is in inflation-adjusted terms, okay? Because the bank doesn't ask to be paid back in inflation-adjusted dollars, only the same dollar in name only. So therefore, in this instance, you've got a $75,000 tailwind every single year in this example. And that's just one of 5 ways that you're paid, as any longtime GRE listener knows. And you know that I've been talking about inflation longer than most anybody and how to position yourself for it. In fact, back in March of 2015, I dedicated a complete GRE podcast episode to inflation. That was episode 11, and it is titled Inflation, How You Are Being Robbed by a Stealthy Thief. Now, let's discuss some of the downsides of a high inflation environment and the threats to you, even if you're positioned smartly with leverage on good properties in good markets. If rent inflation is 10% or 20%, well, hey, that is great for your cash flow. But now how can your tenant afford that? Can they keep up with that? I mean, what's going to happen when the pressure is on your tenant? What if they can't afford the higher rent on your property, especially if their wages are not keeping up commensurately, like I mentioned before? That is a great question, and I'm so glad that you asked. Now, let me give you an answer as to how these high rent amounts have been sustainable as that 19-and-a-half-year real estate investor that I am that has seen a few market cycles and what's happening now in this pandemic-affected real estate market. Now, firstly, especially if you're in single-family rental homes, but it applies to apartments too, people are willing to put more of their income into a home now than before, and that is because they often do more from home now than they did before. Compared to 2 years ago, people don't just live and sleep at their home. More of them also work from home and exercise from home and homeschool and even home garden and more. So the utility value of a home is greater to Americans now than it was 2 years ago. Okay, but maybe that doesn't account for absolutely everybody paying for more in rent, because your tenant still has to be able to afford it, even if it became more important to them. Well, one thing that a lot of people don't consider when we look at rent increases outpacing wage increases is assets. Yeah, a tenant's assets. Tenants don't just have wages. Some of them own assets, and we've seen almost every asset class balloon in the past 5 years. So I'm talking about your tenant's stock account on Robinhood or their cryptocurrency. Bitcoin has 4x'd in just the last 18 months. And now maybe you think, all right, well, I haven't thought of that before. But now what if the price of those assets crashes or craters? We're really getting a little pessimistic now, but let's play this out. I mean, that's still a slightly germane question. Let's look into that. As you know, here at GRE, we have long avoided investing in luxury assets or even above average real estate. We stick to more basic housing, but housing that's clean, safe, affordable, and yet functional. Well, besides these just a little below the median price housing units in a market like we focus on here, because those are the ones that have better cash flow, is that what can happen is that in times of higher rent inflation, like we're seeing now, or even a recession, is that if your tenant moves out, they're often replaced by a more affluent tenant that had lived better previously, that had been living in that higher end environment. That's where your new tenant comes from. And in a market where we have this astounding dearth of available housing to either rent or to buy, your tenant has often got nowhere else to go. It is hard for them to find replacement housing, even if they wanted to move out. So that's what is going on in the real estate market in light of higher inflation and an available supply of housing that is rock bottom on the ocean floor. And like I discussed 2 weeks ago in depth here on the show, we need a 500% increase in the supply of available housing in America just to bring this market back into balance, just for supply and demand to meet. I mean, if you've been an adherent to what we do here at GRE, you are not completely impervious to economic calamities, but you are quite resilient. So in this environment, let's look at the forces that are acting right now on the 5 ways that you're typically simultaneously paid in real estate. Number 1 is appreciation. That's definitely been above average. Number 2 is cash flow. That's been below average because rent increases, now they have come in and risen in a big way, but they have still lagged behind the value increases of real estate. The third way is your return on amortization. That means your tenant is paying down your principal for you. Well, that return on amortization, that ROA, that's been above average because as we've come up a bit off historically low mortgage interest rates, that means that more of the mortgage that your tenant pays for you is going toward your principal and less toward interest. Yeah, we're up off the bottom, but of course, mortgage rates are still historically low. And then the fourth way, taxes, that's been about the same lately. And then the fifth of 5 ways that you're paid, that is called inflation profiting. That is above average because inflation is above average. That diminishes your debt load, as I mentioned earlier in the show here. So those are the market trends right now regarding those 5 ways that you're paid. So this has been really good for you as a real estate investor, and it also promises to be that in the near-term future too. But what about the longer-term future? The Fed plans to raise interest rates to combat inflation starting next month. So let me help you understand why the Fed's doing this. Why would they raise interest rates? And then its effect on you and your personal financial picture. Understand that the Fed has not raised interest rates since the year 2018. And when they raise rates, of course, that increases your cost of borrowing. If your 3% mortgage goes up to 5%, or your 4% car loan goes up to 6%, well, fewer people can afford to make those payments in theory, so then that would slow down the demand for those items. So slower demand, that means less inflation because prices tend not to get bid up so high. Now, contrary to popular belief, if the Fed say they raise interest rates 0.5% next month, a lot of people think they're going to begin raising rates next month. Well, that does not mean that the 30-year fixed mortgage rate goes up 0.5%. All right, so the federal funds rate, that does not directly affect long-term rates. It has a soft effect on them. So Fed rate increases will mean that longer-term mortgage rates are generally headed higher, but they just don't move in direct lockstep with that federal funds rate. But Fed decisions do directly affect short-term rates. So then you would see your HELOC, your home equity line of credit, go up exactly 0.5% in this case, to give you an example. Note that higher interest rate hikes by the Fed, that also means that you and others are going to pay more for automobile loans and for credit cards. Now, on the flip side, it also boosts interest rates on those. And gosh, can I even call them these anymore? I almost can't keep a straight face when I'm saying this. It boosts rates on what are known as high yield savings accounts. I'm laughing because, maybe you've seen those quote unquote high yield savings accounts stuck at about 0.5% interest lately, which is 1/15 of inflation. Now, one risk, and the main worry for economists, is that what would happen if the Fed raised interest rates too quickly and that dampened consumer demand too much? Well, that could slow down the economic recovery. That could lead to a higher unemployment rate if businesses stop hiring or if they even have to lay off workers to stay afloat because demand has been dampened so much. So if the Fed really overshoots rate hikes, it could even push the economy back into a recession, halting and reversing the progress that's been made so far. But even if all of that did happen, it really would take some time to get to that point. Now, with you on your real estate, just keep locking up long-term fixed interest rate debt, not ARMs, unless you know specifically what you're doing, and keep buying and owning this resilient workforce housing like we focus on here, avoiding the luxury condos and the like. So higher interest rates are going to have less effect on you if you keep following that plan. And as I've discussed before, though it's counterintuitive, the last 6 times that mortgage interest rates rose, it's happened 6 times since 1994, house prices rose every single time. And the short story on why that happens is because when the Fed raises interest rates, it is a confirmation that the economy is strong. Hey, well, coming up shortly, we have an in-house chat with our own Andrea talking about the snowballing effect of scaling up your real estate portfolio. Rental property is really a way for you, especially if you work a day job that you don't care for, it's a way for you to become an NFT. Yes, I said an NFT. You can become one of sorts. NFT stands for non-fungible token in the asset world. Fungible means replaceable. So be a non-replaceable person in this life of yours. You know, in most day jobs, if you quit, they're going to replace you in days or weeks or maybe months. But if you develop residual income from real estate, you can leave that job and go create your own life and do something where you're irreplaceable, or be that full-time father or mother or uncle or astronaut or whatever you wanted to be. So be that NFT of sorts. Now, you might be wondering, well, where do I find these properties that provide this cash flow freedom potential and all of the latest real estate news and strategies and things that we talk about here? Well, I have got one great resource for you where you can do all of that. Our weekly Don't Quit Your Daydream email letter wires your mind for wealth. It helps you make money in your sleep and it updates you on really important real estate investing trends. It is full of value and devoid of hype. And the letter is just real content that makes a real difference in your life. Rather than living below your means, learn how to expand your means. You're doing that on this show right now, and we really help you augment that with the newsletter. And I'll tell you, is this the golden age of quality newsletters or what? I mean, there are some good news websites out there, but a lot of them are increasingly riddled with paywalls and logins and banner ads and pop-ups about cookies and more. Well, there's none of that here. I email you this valuable letter directly. It is 100% free. I write it myself. You can get it now at getricheducation.com/letter. It's pretty easy to remember and know where to get that letter. It is at getricheducation.com/letter. So sign up, and after a series of wealth-building welcome emails, you'll then get basically an electronic treasure map sent to you about weekly. And yes, I actually write that letter myself. There are no guest authors or ghostwriters. Get the Don't Quit Your Daydream letter at getricheducation.com/letter. More straight ahead. You know, a lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both: Jacksonville, Florida. They've got 27% lower home prices and higher rents than the national median. Their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and above average appreciation for tomorrow. They often have available inventory in Jacksonville, if you can believe that. Start at cashflowandgrowth.com. You can get a 50-year-old house somewhere or buy a new one directly from the builder with tenant resilient amenities already built in. With over 3,000 Florida units at different construction stages, they are exclusively for investors. President Wagner and Alaska and team also invest strongly in their own product. That's belief. Start at buildtorentdirect.com. That's build the number 2 rentdirect.com or text 407-927-5074.
This is Peak Prosperity's Chris Martinson. Listen to Get Rich Education with Keith Weinhold and Don't Quit Your Daydream.
I'd like to welcome back in our operations lead here at GRE. It's Aundrea Newbern.
Hey, Keith. Thanks for having me back on.
Interestingly, you're now joining me from Brunswick, Georgia. Of course, last year, you and your husband and your young son basically got a second home in Metro Detroit, and you stayed there for a few months, but now you're back in your good old hometown of Brunswick.
That's right. I'm enjoying the weather down here just a little bit more, and also the real estate options just a little bit more than Detroit.
Yes, I'm sure you are. It's a somewhat more thriving real estate market. Now, Andrea, she has a higher degree of formal education than I do. She has her MBA. She's also a licensed real estate agent. And importantly, she is an active real estate investor. So that's what we're talking about today. And Andrea, I know you had mentioned to me before that you had wanted to talk about the snowball effect of scaling up your real estate portfolio. But in order to bring a bit of context to that, tell us about how many years it's been since you bought your first property and ramping up to where your portfolio is today.
I started investing around 2016. So it's been, 5 years, even though it seems like it's longer than that now. I started out small, doing single family homes, duplexes, all in the Southeast. And I actually scaled pretty fast. So I didn't go slow by any means. I'm actually a little slower now than I was, back in the day. But now I have investments in the Southeast. I have some in the Midwest, and then I have some internationally now as well.
About 6 years for you now. And Andrea, you've been growing your portfolio faster than me. Like I bought that first fourplex. It took me more than 3 years until I bought another property because even though I had owned income property pretty early on in my life, real estate, it just really wasn't a main thing for me. But you, through being more intentional and frankly, really listening to this show, you've learned some more about scaling up your portfolio. Talk to us about that because I know you have some newbie investor friends that sometimes they get frustrated when they don't really have their economies of scale and how that first or second property that you buy are probably the most difficult.
Yeah, absolutely. So, I experienced the same thing, and I often hear, friends or clients of mine that are investors, I don't want to say complaining, but they're a little bit more concerned when they only own their first one or two. Because if they have a repair, whether it be a small, a large repair, anything that comes up, it really, really impacts their cash flow. They don't have a ton of cash flow yet. So I've seen lately that it seems to kind of put the brakes on their investments and they're stopping. For me personally, I realized that pretty early in investing that I was never going to get wealthy by just owning one or two properties, or at least not as fast as I wanted. So I mentioned I tried to scale very quickly. So when those repair costs or CapEx expenses or things came through, that didn't have as big of an impact on what I was trying to make each month and be able to pay bills and be able to continue scaling.
That's right. You need to get that snowball rolling and develop those economies of scale. Otherwise, one or two small expenses that might eat up your cash flow for months. And it can also be a bit discouraging to a beginner.
Absolutely. So I had someone the other day that owns 2 units. It's a duplex, but 2 units. She has a net monthly cash flow of $200 per unit, which is pretty good for her first investment.
Good.
She had her HVAC unit go out and she was pretty upset because that HVAC expense that she had was almost her entire monthly net cash flow. The first thing she said to me was, I don't want to buy a bunch more investments if I'm going to keep having these types of expenses and not make any money every month. I sat down and kind of walked this investor through what it would look like once you've hit your 3rd unit and your 4th unit, and how once you hit 10 units, it's almost not even a blip on your radar if you have a $400 a month expense as comparison to 1 or 2.
Right. That's a really good point. To a new investor that just has their first or second, call it rental single family home, you don't really have those economies of scale yet. it can be really frustrating if you have to, say, replace a water heater, and that could wipe out months of your cash flow. And of course, there are some ways to hedge against this. We talk about here on this show how it's so vital to get that third-party inspection before you ever close on the property, even if it's a new construction property. But of course, things can still come up after the inspection. If you buy a brand new property, it might come with a manufacturer's warranty that'll cover some of these things. If there's a renovated turnkey property that you buy, sometimes a turnkey provider will take care of that for the first few months of ownership. And then, of course, there's also homeowners insurance, where if you have a terrific expense, a high expense, once you meet that deductible, your insurer will cover the rest of it. But there sure are some other things that can slip through the cracks. And that's what it sounded like happened with your friend in the duplex there, Andrea.
Absolutely. In today's market, people are selling their houses for top dollar, and it doesn't necessarily mean everything's going to be to the extent of, say, a new build, right? There's going to be issues with these properties, and sellers have a lot more negotiation at this point than buyers. So one of the things that's really important is if you're coming in, with a strong offer and you get it accepted, keep in mind that those sellers may not be willing to make repairs, but you should still try. So if things are found in the inspection report or visually when you've done your walkthroughs of the home, try to ask and negotiate some of those repairs to be put into the contract into an amendment if you didn't get them up front. And that way you're not having as much potential out-of-pocket costs as you would if you didn't negotiate those things into the contract.
Yeah, that's a great point, because that third-party inspection is a great tool for negotiation, and you sure can ask for more of those repairs and just see what the prospective seller will give you. Now, I'm an active real estate investor too, and I'm not waiving my inspections. I'm not seeing others do that. Andrea, from your perspective there, with the deals that you're seeing in the southeastern United States, especially where you're based, do you see any buyer waiving the inspection, feeling pressured to sort of cater to a seller in a seller's market?
We don't. And I will tell my buyers, if you are going to lose this deal because you had to waive your inspection, lose the deal. We'll find another one for you where you get your inspection and you don't have that amount of risk that you're taking on. One thing I'm seeing more frequently than waiving your inspections right now is tightening your due diligence period. So it's a week or 10 days as opposed to the traditional 14 days. And I think that's okay as long as you can get your inspections done.
What I like to tell people, Andrea, tell me your thoughts about this. As a buyer, as soon as you have your offer accepted, one of the first things you need to do is schedule that inspector. Get them on the schedule. They're in demand.
That's right. And one strategy that I currently use is before we even get the offer, I go ahead and call the inspector and say, how far out are you right now? Can you go ahead and put me on the schedule for the next inspection you have? And if for some reason I need to cancel that because we don't get the contract, I'll call and cancel. But that way we're on there, even if it's a couple days back and forth with negotiation, we can get it done very quickly.
Hey, if that inspector is willing to take that appointment for something that's not quite under contract yet, that's great. That's really being proactive. So we'll talk more about this snowballing effect of scaling, Andrea. Talk to us some more about how, as one migrates along in their investor path, how their income increases and how they're able to spread out their fixed costs and so on.
Couple things to keep in mind. When you're a brand new investor and you own one or two properties, you may not have necessarily kind of built up that team that is your trusted team that has the connections in the community to get you the cheaper repairs if you need to, or if you're doing any type of renovations to be able to get some economy of scale if you're doing renovations to multiple properties at once. When you have a lot of properties, or even 5 or 6, you now have your management team in place, hopefully. If you don't have your management team in place and you're self-managing, you now have vendors that know you. They know you're going to pay them on time. They know you're going to be easy to work with. And you're also able to spread out your costs for things because those vendors are typically going to offer you the services perhaps a little bit cheaper than they would someone they don't know. And they're also going to get to you a lot faster to get things fixed, which ultimately impacts things such as your turnover, how happy your tenants are. And this just increases your profits and keeps your expenses down a lot. For example, one of the things that I like to do is I like to try to get a couple of houses under contract as quickly as I can if they need renovations and try to do them close to each other. So that way I can have one team that's working on both of these houses. We're in bulk purchasing the flooring or, the countertops or anything that needs to be renovated. And that way we're spreading that cost across both units, getting it done quicker, and we're not delaying kind of the revenue that we would get if we're listing those houses. I'll also often be able to get discounts from the contractors, the vendors that are performing these services because they're doing multiple properties for me at once. So that's one way I really like to kind of structure things, if at all possible, to be able to get them in there and get them going as fast as possible and at the same time.
Yeah, just breaking through and getting that first one or two. Even when I buy turnkey properties, Andrea, anymore, it wasn't always this way. I want to get two under contract at once to just have that one credit check. And I'm going through a lot of the same motions, whether I'd be buying one property or whether I'd be buying two properties. So I'm trying to be encouraging to the beginning investor here. Maybe you're not able to do that right away. There's just nothing more important than getting started with that first one or two. It's also how you do the best and quickest learning, these real world lessons.
You make a really good point there. I have an investor right now that was, I don't want to say complaining, but she was a little bit discouraged because she said, this is my first property. And look at all these things the lender is asking for because we're self-employed. She said, I've spent, 2 days now explaining things, providing documentation. And I said, but look, you're now under contract for properties 2 and 3, and you're not going to have to do any of that for those next 2 to 3 properties because they've got all the documents. They have your tax returns. You've already answered all of these questions. So you make a great point, Keith. It makes it easier if you can get a few at the same time.
Mortgage loan underwriting can be somewhat of a pain for the borrower. There's just no doubt about that. There's a lot of documentation that you have to get together, your last 2 months bank statements, your last 2 years tax returns, a credit report and pull, maybe making sure that your debt to income ratio is in shape and all that. But the plus side of this for you, that prospective borrower, is still historically low mortgage interest rates. And in a sense, it's pretty good that the underwriter still has some guidelines that you need to stand by, because that helps provide support for the market in having borrowers that can indeed qualify and make their payments.
Absolutely. And, one thing with all of this going on with still being, I don't want to say difficult to get credit and to get these loans, but not like it was in 2007, 2008, right? It's a little bit easier than it was at the time. But if you are coming in and you're an investor and you're getting a conventional loan and you're putting 20% down, your offer is also going to beat out most likely someone who is an FHA borrower who's putting 3.5% down. So investors are already coming into these negotiations with a lot of purchasing power at the moment.
Yeah, that's a really good point. As this snowball rolls and begins to gather mass, as one grows their portfolio, a lot of times profits can increase because you're able to have that portfolio be managed more effectively, like you've touched on. How have you liked to grow and develop your portfolio, and how do you like to tell people that you deal with in the industry, Andrea, as far as when you do have that positive cash flow, which is more reliable, the more properties you have, do you advise people to sort of take that cash flow and kind of put it aside as a down payment for another property, or should they spend half of it? Or what kind of thoughts and mindsets have you seen around what people want to do with this, basically this additional income stream in their lives? They've given themselves a raise, which is what you do when you're buying income property. You don't have to go and ask your boss for a raise and hope it's there. You kind of give yourself one once you get this momentum with a portfolio. So talk to us some more about that mindset and the mechanics of growing that portfolio and getting that snowball going.
Great question. So I think my first answer to your question of what am I seeing or what would I recommend per se is, I think it depends on your individual situation. If you have passive income from other areas, or you plan on continuing to work and you don't want to stop work, so your goal is not necessarily quitting work through this passive income, then put the money aside. And if you want to spend it to supplement your lifestyle and enjoy your life and live today, do it. That's great. If your goal is, I want to retire in the next 2 to 5 years, I would highly recommend putting as much as possible of that net profit away. And then when the right deal comes along, purchasing that deal and scaling so you have that snowball effect much faster. The longer you wait to purchase and the less amount of properties you purchase, the longer it's going to take you to achieve that financial freedom.
That's right, because I think we've all seen these charts where it's sort of applied to compound interest. For example, if you start investing $500 a month when you're age 18, oh, well, my goodness, if you postpone until age 30, you would have to save something like $2,000 a month just to get to where you would have been at age 18, saving that $500. Well, that's with compound interest. But what's better than compound interest? That's leverage. The more properties you're leveraging earlier, the better you set yourself up for later. But yeah, it kind of gets to be a touchy-feely question as to what do you want to do with your cash flow?
That's exactly right. And, I get a question a lot of, well, I do want to quit my job. I want that financial freedom and to be able to walk away from my W-2 job and have this passive income. But I'm nervous because what happens when I quit that W-2 job and I can't get more loans and more properties because I can't qualify for the loans? So one thing to keep in mind and to talk to your tax professional about, because we're clearly not CPAs here at Get Rich Education, is whether from that passive income and the income that you're making your properties, if you can create a company and pay yourself W-2. So there are ways to continue. You can step away from your W-2 job and create your own W-2 job through your own company and do all that from your passive real estate. So that's another way to kind of snowball affect things and not have to stop getting loans if you're self-employed and you haven't quite met that 2 years of self-employment income requirements.
That's something that I have not done before. So can you tell us some more about setting up a company? Are we just talking about an LLC for your real estate investments? Or tell us more about the mechanics of that.
You want to set up the tax structure or the business structure that's best for your individual situation. But there are a lot of investors out there that set up these LLCs and they pay themselves, or a corporation, right, an S Corp, and they pay themselves a W-2 salary through that company. And that way it's showing that you still have a W-2 salary. And when you go to a mortgage lender, you're not having to prove, 2 years plus of self-employment. You're able to say, hey, yes, I left my W-2 job, but I've now transitioned into another W-2 job. And here's my pay stub from this W-2. So it allows you to continue that flow of buying properties and not having to stop and take a break while you're waiting on that 2 years of self-employment.
That is a really good tip in qualifying for more loans. Well, Andrea, do you have any last thing that you can tell someone about starting out and kind of getting this snowball rolling? And before you tell us that, while you're thinking about it, something comes to mind actually that a former guest, Frank Gallinelli, shared with us on the show here. And I think he wrote about this really powerful sentence in one of his books, Andrea. And that is, when it comes to real estate investing, unexpected expenses are more common than unexpected income. So it's really kind of a sad truth, but that is what occurs over time. You sometimes get this surprise expense out of nowhere, and it seems like that tends to happen more often than you would get any sort of unexpected income. Although more unexpected income has been coming lately with these torrid year-over-year rent increases. But just in order to set a new investor's expectations, I would keep that in mind. That just expect to be blindsided by some rogue expense somewhere along the line. Do you have any last things, especially for a new investor or someone as they try to get this snowball rolling, Andrea?
First of all, I love that quote. That is fantastic.
Yeah.
It's a really good one. The one thing I would say is that analysis paralysis that I think we've talked about in prior episodes. When you're seeing these expenses hit, don't let that stop you from moving forward. That just means that should propel you to move forward and to continue buying cash flowing real estate investments so that that doesn't hit you hard the next time it happens. So don't let things stop you. Keep moving forward. Keep getting good deals. Don't just buy anything. Get good deals, but don't stop.
Hey, well, that's great, prudent advice. I really think that's going to help a lot of beginners. Any last thoughts, Andrea?
I don't think so, but thank you so much for having me back, Keith.
Thanks so much. Oh, yeah, some great knowledge and perspective from our own Andrea here. You can see why she came on board more than a year and a half ago to help me out, can't you? She is an active investor and really articulate too. Yeah, sometimes you hear about real estate investors where things just didn't go well with them. They kind of got turned off from real estate. Maybe their first tenant paid the rent late or something else untoward happened and they decided to sell their property and give up. But you know what? And most anyone that says something like, I got educated in real estate and I played the long game. I mean, almost anyone that says that is probably really profitable. And yeah, maybe even on their way to being an NFT. Early investors, they only have their eye a lot of times on cash flow, and that's because they haven't had enough time to feel the leveraged appreciation and all the other benefits from the 5 ways that you're paid. So often it's about taking that long view past that first unit or past that second unit. And in today's market, you might not even have to add much of your additional money because appreciation is so rapid that you can take your, say, 2 units and 1031 exchange those up into 4 units really fast. Now, if you happen to be within the state of Georgia, which is an investor advantage state, and you're looking for either long-term rentals or short-term rentals, You can get a hold of Aundrea Newbern the same way that you write into our general mailbox about any comments that you would have here platform-wide. So if you're looking for Georgia property, reach out to Andrea at info@getricheducation.com. Nationwide and internationally, if you're looking for rental properties to help you expand your means, you can get started at gremarketplace.com. That is the same place where I add properties to my own portfolio. So sign in and connect with our entire provider network right there, all from one sign-in at gremarketplace.com. Thank you for the privilege of your time. I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.